Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Bouncing back, Japanese stocks surge with European and US futures also pushing higher. San Francisco Fed President Mary Daly emphasises that the Fed does not need to react to one data point. On the ticket, Kamala Harris formally wins the Democratic presidential nomination. We discuss her options for a running mate. Plus, the UK Chancellor declines to rule out increasing capital gains tax. We bring you our exclusive interview with Rachel Reeves. So a pause to the sell-off after Manic Monday, but will that be sustained? Remains a key question as we monitor these markets after that historic day yesterday. More than $6 trillion wiped off global equities. But again, a breather in the session so far with European futures, as you can see on the screen, pointing higher by around 1% after the losses of more than 2% yesterday in the European session. And of course, for the Nasdaq 100, the worst start to the month since around 2008. FTSE 100 futures pointing to gains of 71 points. As things stand, S&P E-minis also pointing higher by around 1.4% after the losses of around 3% yesterday. Nasdaq 100 futures looking to add 311 points. Let's flip the board and look cross-asset then, because the weakness in the yen is a story of the day, of course, after that incredible strength that we saw yesterday for the Japanese currency with gains of more than 2%. Some of that being unwound then in the session so far today. We know the carry trade was an important part of the mix when it comes to the negativity across these global markets yesterday. Today, the Japanese yen at 145.46. The two-year stateside 397 right now, getting close to that 4% level after that huge rally in US Treasuries. Now a little bit of selling pressure, yields up 5 basis points. Brent at $77 a barrel and Bitcoin at 55,535 after that rout yesterday for cryptocurrencies, a drop of about 10%. Gains in the session today of around 2%. Let's cross over to Avril right now. Avril Hong standing by in Asia with a check on the market. Standing by in Singapore. Avril, what are you seeing across the screens?
Well, we're seeing a bit more green creeping into the screen. I mean, after the wipeout a day ago, perhaps unsurprising that we're getting these comments about how the markets had overreacted. Dip buyers are emerging. We're seeing the Nikkei, the topics earlier today, about 10% higher, number of circuit breakers triggered. There was a sense that, we could see a bit more of that calm returning to the markets, but don't forget how badly hit investor sentiment has been. So it's going to take a while to fully recover. But the BOJ has certainly been coming under fire amid the market meltdown, criticism about the timing of its rate hike last week. Of course, the onslaught yesterday was more to do with concerns about the U.S. economy. But nonetheless, we're seeing some of the speculation that with regards to future rate hikes, that could be put on hold. The yen is losing ground today, as you mentioned, after that 5 days of rally. Now, flip the board, because if you look at how Japanese bonds are faring, they've been part of that global rally, and those yields have really been coming down quite rampantly. And amid all this, there was always going to be a tricky setup for a 10-year auction today. And this is the first, don't forget, after the BOJ's decision last week. And indeed, given the lower yields we're actually seeing in terms of demand, it was the weakest, according to one measure, since 2003. So a really interesting picture we're seeing in Japan assets as we see stocks elsewhere in the region also rebounding today. Tom.
OK, Avril Hong in Singapore with that rebound in Asian markets. And again, we'll see to what extent that can be sustained. Avril, thank you. Now, Japanese stocks on the Japan story now specifically, because it's so fascinating in terms of what's unveiling and the read across to global markets as well. Japanese stocks then rebounding strongly, as Avril was saying, just a day after their plunge into bear market territory. Let's get the details then and bring in Bloomberg's Winnie Su out of Tokyo in terms of how this story is unfolding. Winnie, are we likely to see buyers continue to kind of buy the dip in Japan? Is this just a temporary breather? What is the sense from traders on the ground in Japan as to what has unveiled and what has come to pass just in the last 48 hours or so out of Japan?
Sure. Even after today's very powerful rebound, investors are actually still quite cautious in the near term in terms of, when we look at the market volatility and just some of the key risks in the market still remain. And as we look at the sharp decline on Friday and yesterday as well, the main drivers are still there, right? The worries around the U.S. economy, slowdown, and also with the yen. So a more hawkish tone from the Bank of Japan and the yen appreciation as well as the volatility in the currency. Along with a potential reversal of the carry trade to continue, those are actually still weighing on Japanese stocks. So until those factors are out of the way, investors are likely to remain quite cautious. And Goldman Sachs today had a note on how they see this mood to continue for the time being, especially after the retail investors were hurt during this big decline. So it would take a lot more time for sentiment to return and for people to buy into the bull story of Japanese stocks.
Okay, yeah, what a turnaround from earlier in the year when so many investors we had on the show were talking about the benefits coming through in terms of exposure to Japanese equities, corporate governance, the upside, and of course what was happening with the yen, and that has all, of course, turned. So we see if those additional catalysts come through to give some support to this market, but as you suggest, it could be a challenged few days. Winnie, Sue, Tokyo, thank you very much indeed. Really appreciate the update. Let's get a check now on what's happening in the Treasury market. The Treasury rally then igniting, of course, a debate on how fast the Fed needs to cut interest rates. Two-year yields, which are, of course, sensitive to monetary policy at the front end, were pushed briefly below the 10-year note for the first time in 2 years. So that disinversion did come through before reversing to some extent yesterday. Let's get the details now in terms of how this Treasury market is reacting and repricing. Bringing Bloomberg MLive strategist Mark Cranfield. Mark, so traders now pricing in more than 100 basis points of Fed cuts by the end of this year. Are they set up for disappointment once again?
It's like a game of chicken. Who's going to blink first? Is it the Fed or the traders? And for now, the traders seem fairly confident that they've got it right, that they've seen the data. They've seen a couple of softish employment reports, especially the one last week. And they've seen Jerome Powell himself say that the employment situation is changing, deteriorating. And so that is really emboldening them. And then you get the equity market going into a tailspin as well, which obviously is something that often feeds in to a softer economic policy, and the Fed needing to respond as well. So you put all those things together, and it's no wonder that traders are pretty convinced, not only in September is there going to be 50 basis points, but there's going to be more cuts to follow quite quickly after that, leading to at least 100 basis points worth of cuts. Now, we have plenty of Fed speakers coming, some in the next week or so, and they may push back a bit. They may well say, look, calm down, everybody. You're all overdoing it. There's no need for us to panic and start doing quick rate cuts and big rate cuts like that. But there's an inflation report next week. It's a big one now, the CPI report. If it comes in on the downside, if we get a soft number, traders will be even more excited that the Fed is behind the curve and they can justify their 50 basis points. So for now, it's very much a question of the traders are going off the data they can see. They can see the unease in global markets. All of that to them points to the fact that the Fed need to act, and they need to act big to try and restore some kind of confidence in markets. Of course, they still want to see a few more pieces of data, but the traders are not going to give up easily. The Fed will need to push back quite aggressively to stop this.
OK, so we look ahead to that inflation print, and you can imagine many will be on tenterhooks, as you suggest, leading up to that print next week. Meanwhile, we have heard from Mary Daly of the San Francisco Fed saying we still have a reasonably solid labour market when you lift the hood. The volatility, I mean, the VIX getting to those highs we haven't seen since, the 1990s, record highs in terms of some measures yesterday. What do you make of the surge in volatility and what that tells us about the near-term outlook, Mark?
This is going to really be a dampener on markets in general, at least for the rest of this month. Because what's happening is that when you get these huge spikes in volatility in specific assets and generally across the board, we've seen it in currencies, in equities, in commodities. What this tells you is that the inputs that go into risk management, the value at risk numbers, they all explode higher. And that means that if, say, for example, in Japanese equities, which have been extremely volatile, If you were holding 100 units, you probably now can only hold 25. So that reduction, the fact that your risk manager is telling you these things have become so volatile, you cannot hold such a large position anymore, means that some people are forced to reduce positions. That's forced selling into the market, probably at a time when they don't even want to do it. They're probably saying, well, these positions we have on a long-term basis look very good. And the risk managers are saying, well, for the time being, they're just too crazy. You need to get rid of a few. So you're going to have that going on across the board, in multi-asset managers especially. And it will affect currencies, commodities, bonds. Everything is in the mix. So people who've had a difficult start to the month are going to find it very hard to get back on track because their positions will be reduced substantially. So a lot of people will be on the sidelines and will have to wait until September. And that is going to make the markets even more choppy in the short term, and it will be a bit directionless. It will be much more difficult for people to decide what is real and what is not real in the next couple of weeks.
OK, Bloomberg M-Line strategist Mark Cranfield on the challenges around a more volatile environment, of course, with the VIX hitting those levels unseen since about the 1990s yesterday. Mark, thank you very much indeed on these market adjustments, significant as they are. Now to the tech story, and this is pretty significant as well. A US judge ruling that Google illegally monopolized the search market through exclusive deals with Apple and others. Google paid billions to make it the default option on smartphones and web browsers. The company plans to appeal the ruling. Let's get more from Bloomberg's Annabelle Drulers. Annabelle, this is significant. The focus, of course, in terms of the regulators and the squeeze on Google. We haven't had a ruling like this for quite some time. What, for you, are the kind of takeaways and the main implications of this ruling?
Yeah, as you said, we haven't seen a ruling like this for more than 2 decades now, so it is extremely significant and a big win for the government. What was being questioned, as you said, was Google being the default option on phones and web browsers. So, for instance, you get a new iPhone and Google is the search browser that's already loaded on that. Now, Apple pays for that right, and it came out during the course of these hearings in this case that they'd paid around $26 billion to do so to other companies like Apple, like Samsung. Now the finding from the court in Washington is that those deals created a monopoly such that it locked out any other competitor from the market. And so because of that, the court also found that Apple was able to continue increasing the price of its online advertising pretty much unencumbered. So because of that, the finding was that Apple had created an illegal monopoly. The consequences, of course, is what we all want to know about. We do know that the judge in the case has set a hearing for next month to try to discuss the timing for a separate trial on the course for a remedy. Google, for its part, or Alphabet, has said that it's going to appeal the decision. The reaction, of course, coming through in the share price reaction because Google felt, Apple felt sort of caught up, not just in that broader tech sell-off, but concerns around this case in particular and the ramifications.
Yeah, and some of those ramifications could potentially lead to a breakup of some of these units at Alphabet, but of course that remains a key question. Meanwhile, Annabelle, Nvidia and details about its plans around innovation, the next iteration of its chips with Blackwell in focus, and some reports that maybe they're facing some engineering challenges on that front.
Well, as you know, Tom, the pace of innovation at Nvidia has just been so fast and furious that now it seems like Nvidia itself could even be struggling to keep up for it or with it. But the story here in question was first reported by The Information, and Bloomberg as well has been able to speak with some sources directly on this. And what we're hearing is that Nvidia is facing production delays. Now, these relate to 2 AI chips, which could affect production of the entire Blackwell system, which, if you recall, of course, was announced back in March of this year. Nvidia did not comment on these reports in particular, but they did say that production generally is on track to ramp up in the second half of this year. Analysts at this point, we did see that slide in Nvidia coming through, but they are still taking it pretty much in their stride. If it's a weeks long, a few weeks, you know, it's not too much of a problem perhaps for the company. The question really is whether it goes on beyond that, because The Information, for instance, was reporting that the delays would mean that we wouldn't see any sort of big shipments for the Blackwell until the first quarter of next year or first quarter of 2025. What the company itself is saying is that we're going to start seeing Blackwell revenue in the course of 2024 instead. So really big question marks over it. We are going to be hearing from the company, of course, because we've got earnings just around the corner at the end of this month. Perhaps a bit of an opportunity to hear more about it. But as I think I heard you mention earlier, Tom, as well, some companies already starting to look to capitalize on this. And AMD is one of those. Their shares managed to rise yesterday, given it could look to, as I said, capitalize on those delays.
Yeah, and that just about a week after they raised their sales outlook in terms of their AI accelerators as well. So we'll see if that trend continues. With the update, of course, on those important tech stories for us, Annabelle Drewlers out of Hong Kong. Thank you very much indeed. Here's what else we'll be thinking about then today. 7 a.m. UK time on the earnings front. Intercontinental earnings will be coming through. We'll break those for you, of course, at 7 a.m. UK time. 10 a.m. meanwhile, Euro area retail sales. So we'll get a gauge of the consumer across the Eurozone as some of the data has been a little soggy across the continent in terms of the health of this economy. And later, the US Treasury will sell $58 billion worth of 3-year notes. So we'll see to what extent investors are willing to absorb that after the volatility, of course, in the Treasury markets. Maybe there will be increased demand given the bond rally that we've seen over the last few days. On the earnings front as well, one of South Africa's largest banks, Nedbank, with that big domestic focus, coming through with a mixed set of results. Quite honestly, the top line in terms of net interest income is a miss in the first half for Nedbank. But when it comes to the interim dividend per share, that is coming in above the estimates, 9.71 Rand. That is above the estimates of 9.29. So it's a beat in terms of the interim dividend per share. But in terms of the net interest income, the top line coming in slightly softer on that front than the estimates. We're going to be speaking to the CEO of that bank later this show, Nedbank CEO Jason Quinn, later this hour. So stay tuned for that conversation. Coming up, Kamala Harris clinches the Democratic nomination. It is now official, setting up that matchup, of course, against Donald Trump. More on the race for the White House and her potential VP pick. That's coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Tuesday, everyone. Now, Kamala Harris has formally clinched the Democratic nomination for president after winning a virtual roll call. Next up, then, a decision on her running mate. The opening trade anchor, Kriti Gupta, joins me for the latest. Of course, always has a finger on the pulse firmly of US politics. It is now official, then, Kriti.
It's official. Happened with the virtual roll call just in the last 24 hours. I think the kind of parade and the pomp that we were expecting out of this is quite limited. And I think that really tells you about this idea that it was kind of a foregone conclusion that Kamala Harris was not only going to clinch the nomination, but she was going to be the first black woman and the first South Asian woman to do it. So this is a historic moment for both sides of the party, of course, for the American people as well. I think the next step here is how she's going to be campaigning. Look, the pollsters are still saying she's in a little bit of a honeymoon phase. She has this momentum on social media. Is that going to last into September when you really start to see what a lot of people are calling the real polling actually come forward at a time when that initial lead, that initial kind of gap that she had in some of the polls against President Trump start to narrow? Of course, a big part of that question is going to be the vice president pick. We are still, of course, on the edge of our seats waiting for that decision. But it looks like Reuters coming out and reporting that Mark Kelly may be out of consideration, narrowing it down to two key names, which is Josh Shapiro, the governor of Pennsylvania, and then Tim Walz, which is the governor of Minnesota. And I think the emphasis I need to put here is they are both governors. They are not senators. That is significant in terms of things like polling, which Pennsylvania, of course, has been polling very much in favor of President Trump, decide having a Democratic governor as well. So this could be something that helps her ticket. On the other side of the equation, she also has to really appeal to the labor crowd as well. Remember, Sean Fain over at the UAW has actually been pushing for a third candidate, Andy Beshear, who's the Kentucky governor. So she's really trying to figure out, and her campaign is trying to figure out which part of the demographic she wants to appeal to the most. And I guess we'll find out soon. Yeah, that vetting procedure has been accelerated, hasn't it, as a result of the time frame. Kriti Gupta, thank you very much indeed. On the update, of course, now official that Kamala Harris is officially the candidate for the Democratic Party, leading up to the vote, of course, in the US in November. And we will bring you, of course, that VP pick as soon as we get it. Coming up, UK Chancellor Rachel Reeves says the UK will strike the right balance at the budget, but she will not rule out increasing capital gains tax. More then from our exclusive interview next. This is Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Now, UK Chancellor Rachel Reeves says she will not rule out increasing capital gains tax after warning that difficult decisions will be taken to fill a £22 billion gap in the budget. In an exclusive interview, she told us that the UK will strike, quote, the right balance on the tax at the budget in October.
I think people should pay their fair share of tax, and one of the challenges we have in the UK is a gap between what should be collected by His Majesty's Revenue and Customs and what is actually collected. But we made a commitment in our manifesto that we'll be sticking to, which is that we don't want to increase taxes on working people, and we will be keeping income tax, national insurance and value-added tax at the rates they are for the duration of this Parliament. I would like taxes on working people to be lower, but I believe that you can't make promises without being able to say where the money is going to come from. But the tax burden in the UK has got too high. The tax burden in the UK is at a 70-year high. I want to bring that tax burden down because I want to make Britain the best place to start and grow a business, and I want working people to keep more of their own money in their pockets, and that's what people will have with this new Labour government. And it's why it's so important that we grow the economy, because the last few years in the UK, there's been lots of debate about what level of taxation and what level of spending, but it's missed the bigger picture.
Yeah.
And the bigger picture is growing the economy.
Well, as you mentioned income taxes there, Chancellor, I wonder, given the revenue it potentially could generate, if you're tempted to bring capital gains taxes in line with the income tax, is that something you're considering?
We've got a budget on the 30th of October and we'll set out our policy then. But it's always important when you're deciding tax policy to strike the right balance. Of course, you need to bring in the revenue to fund vital public services, but we've also got to grow the economy. And I won't do anything that makes it harder to achieve that economic growth and prosperity, because in the end, the only way we're going to lift living standards for working people and have the money that we need to invest in our public services, whether that is our health service or our schools or indeed our police and our armed forces, is by growing the economy. And so I am determined to ensure that when we set all of our policy, including tax policy, that we're not doing anything that will deter the investment and growth that we need to see in the UK economy. But we'll make decisions around tax and around spending at the budget and the spending review later this year.
UK Chancellor Rachel Reeves speaking exclusively to Bloomberg. Now to other stories making the news this Tuesday. The UK government says foreign states may be involved in fueling a wave of right-wing riots across the country. Prime Minister Keir Starmer says they will mobilise a standing army of police officers to deal with the violence. The unrest has been fuelled by online misinformation following the murder of 3 young girls last week. Starmer's administration has also slammed a post on X by Elon Musk that, quote, civil war is inevitable in the UK, saying there was no justification for the billionaire's remark. And shares in Palantir jumped in extended trade after the company raised its annual outlook, citing continuing demand for its AI software. In a call with analysts, the CEO said the earnings report was historic for the company. Palantir provides data analysis tools to companies and governments, including for defence and intelligence purposes. Coming up, Aramco earnings in focus. The oil giant expected to get a boost from higher oil prices. It's been a laggard, though, in terms of the stock price year to date. We have the details next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom Mackenzie in London. These are the stories that set your agenda. Bouncing back, Japanese stocks surge, with European and US futures also pointing to gains. San Francisco Fed President Mary Daly emphasises that the Fed does not react to one data point. On the ticket, Kamala Harris formally wins the Democratic presidential nomination. We discuss her options for a running mate. Plus, a monopoly on search. A judge rules Google acted illegally, handing the government in the US its first major antitrust win against a tech giant in more than 20 years. Let's check in on these markets then, and Alphabet taking a hit post-market on the back of that decision. We'll keep across, of course, tech given the rout that we've seen in recent days, but futures pointing higher. Take a breath, everyone, because there seems to be a pause, at least for now, in the selling that rippled across global markets yesterday. But for how long will this relative relief be sustained? European futures pointing higher by a little over 1%, looking to add 51 points after the losses of around 3% across the European benchmark yesterday. FTSE 100 futures here in the UK looking to add 85 points, up a little over 1%. S&P futures looking to add 1.4%, again after losses of around 3% yesterday. Nasdaq futures also pointing higher, currently by around 310 points after the worst start to the month since 2008 for the Nasdaq 100. Let's flip the board and look cross-asset then, because there is now in the session today a little bit of selling across the bond markets. We haven't been able to say that for the last few days. Yields are up 4 basis points on the 2-year at 396, edging back to that 4% level at the front end after that disinversion came through yesterday. The Japanese yen at 145, a little bit of weakness now after the strength of the last few days for the Japanese currency, currently down 1%. Brent at $77 a barrel, gaining 1.2%, and Bitcoin, a bit of relief coming through there as well after a 10% rout yesterday, currently up 2%. So not making up the gains, of course, but pairing some of the losses that have come through for the major cryptocurrency. Now, in terms of the earnings front, we're getting details crossing from Bayer, and this is a company, in terms of the stock price at least, that's been challenged. Year to date, the stock is down around 19%. So in terms of the earnings that have come through for the second quarter, the red head is this for the key chemicals maker. Bayer, in the second quarter, adjusted earnings coming in bang in line with the estimates at 2.11 billion euros in terms of the top line when it comes to the second quarter adjusted earnings for Bayer. It's raising its sales forecast for the pharmaceutical division. So that's a raise of the sales forecast for the pharma division. It has confirmed its outlook for the full year. The margins in the second quarter coming in a little bit below the estimates. 18.9%. The estimates had been for 19.4%. But top line, in terms of the earnings adjusted EBITDA for the second quarter, in line with the estimates. Let's get the details now on Saudi Aramco, because this is a company, in terms of the oil majors, of course, firmly in focus for us. It has been challenged as well as underperformed the rest of the market, given that the government there, of course, has imposed these cuts on the company. Aramco, second quarter net income coming in at 106.16 billion rials, a little softer than the estimates in terms of the second quarter, and it expects to declare a total dividend of $124 billion in 2024. Total revenue for the second quarter coming in above the estimates. So the second quarter total revenue above the estimates, 470 billion rials. The estimates have been for 421 billion rials. Let's get more details on the earnings story then when it comes to Saudi Aramco, and bring in Bloomberg Horizons Middle East and Africa anchor Jumana Pasechi with the details. Jumana, your reaction, what are you taking from these numbers coming from a stock, of course, an oil major that has underperformed many of its competitors in the US and Europe?
Yeah, well, instant reaction is that we are getting numbers pretty much in line with expectations, so not veering away from what analysts had penciled into today. And it's broadly a reflection of what's been happening to the oil sector as a whole. One of the takeaways from the earnings season is that those upstream numbers, the numbers coming from overall oil production, have actually surprised to the upside, because there is benchmark pricing power, and that has come through from many of the other oil companies that have reported, including the likes of Chevron, Exxon, for example. Some of the weakness, however, does appear to be apparent on downstream. Again, and this is a universal theme that we're seeing in the space, refining margins are coming under a lot of pressure here. And so putting that all together, it seems as though from Aramco's perspective, some of the strength on upstream has offset some of the downside pressure that is coming through from a downstream perspective. But it is interesting to hear some of the commentary that they've come out with today, saying that they are confident in medium and long-term demand growth forecasts. Why is that important? Because you'll remember that, of course, the Saudi government has a 97% ownership in Aramco. And so when OPEC Plus come out with these decisions to pull back or to keep production off the market, it is Saudi Arabia that's driving those decisions, and invariably that's going to be Aramco hitting the production outlook for Aramco. And so the fact that their commentary is positive about the outlook perhaps should provide a bit of support to investors' perceptions here, and that maybe there is room for them to start increasing their own production in coming quarters.
Yeah, we have to wonder what they're seeing in the key Chinese market. We look, of course, at concerns about the growth picture in the US as well. And you're absolutely right to point to the softness downstream in terms of the squeeze on refining margins. When it comes to OPEC Plus and its allies then, Russia, of course, part of that mix, what is your sense, Jumana, in terms of how the story, how the narrative is likely to adjust in the coming months ahead for the cartel and the role that Saudi Aramco is playing within that decision-making?
Yeah, so when you think about the Aramco stock, there are two things that you need to consider. The first, of course, is it is the largest oil company in the world, but it is still 97% owned by the Saudi state and therefore will be subject to the variations in OPEC Plus production. And so if you are of the view that it's going to be difficult for OPEC Plus to put barrels back to the market again in the fourth quarter, then you will have a somewhat downbeat view of Aramco's own production profile. The second element to consider is the dividend payout. So out of all of the oil majors out there, Aramco is known for having the most generous dividend yield of around 7%. And what analysts are saying is that it's going to be difficult for them to continue paying out these dividends. According to Bloomberg Intelligence, the dividend payout now actually is higher than the free cash flow that Aramco is generating, putting them in a net negative cash position. Of course, that is not sustainable. They'll have to take on more debt if they want to keep paying out these very healthy dividends. And so when you look out to the future, two things need to be in your mind. Number one, can Aramco increase production? Number two, can they continue paying out these dividends? And if the answer is probably not, or your assessment is bleak, then you would have a more bleak assessment of where the stock is going. And that explains some of its underperformance this year, Tom. It is down almost 19% on the year when most oil majors are up almost double digits.
OK, quick fire and comprehensive reaction then from Jumana Pasecci, our Bloomberg Horizons Middle East and Africa anchor, to those breaking earnings coming through from Saudi Aramco. Jumana, thank you very much indeed. Now, the Fed San Francisco president says the US labour market is softening, indicating rate cuts in the coming quarters. But Mary Daly added that the pace of cuts will depend on more data.
We will make policy adjustments as the economy delivers the data so that we know what is required. If we reacted on one data point, we would almost always be wrong.
OK, let's get more from Bloomberg's Ven Ram. So, Ven, we heard there from Mary Daly saying we need to wait for more data. We have the inflation print coming through from the US next week, but markets are pricing in more than 100 basis points of cuts before the end of the year. By the end of the year, there's expectations that maybe even they deliver an emergency rate cut. Look, Ben, you've been across it. You've followed the machinations of the Fed, the implications of these treasury markets for a long time. What is your take on this debate around an emergency rate cut?
Morning, Tom. Good to be talking to you. I think this idea that the Fed will come out swinging and make an emergency rate cut is frivolous and sensational. But I don't think they're going to do it. Excuse me. The Fed has done it before, but during those times, the real economy was in distress as opposed to the market's economy. Back in 2008, the Fed made 2 emergency rate cuts, but at that point, there was a global financial crisis. The major financial institutions, some of the most preeminent financial institutions in the world, were going belly up. So there was a real need for the Fed to come in and revive the economy. Back in 2020, again, during the pandemic, the markets were seizing up and the economy needed all the help and rescue it could take from the Fed. And that's what the Fed did with 2 emergency rate cuts in March 2020. But right now, the situation is not far from that. The economy is doing modestly well, not as robustly as it was doing perhaps last year, but there is no suggestion that the economy is keeling over. What is happening is an unwind of carry trades, and the Fed would be happy to let those carry trades unwind because there's a lot of froth in the market. So the idea that the Fed would come out swinging and make an emergency rate cut is, to me, Tom, pretty laughable.
OK, a laughable prospect as you focus on the unwind of the carry trade versus the fundamentals, suggesting there is a big difference between the two, or at least one is more of a catalyst than the other. And in terms of these treasury markets, then we're seeing a little bit of selling, of course, after the huge rally that we've seen over the last week or so. A little bit of selling coming through across treasuries today. The 2-year back at 397 with yields up 5 basis points. Markets then pricing in an additional 2 cuts after September. September seems all but locked in at this point for these markets. We'll see if there's any pushback to that at all. And then a further couple of cuts expected by these markets post-September. What do you make of the moves within the Treasury markets as they reprice around this? Is 4%, is sub 4% on the 2-year reasonable? What is your assessment in terms of how the curve adjusts?
I think that the front-end yields have got to go a little bit higher. The 2-year north of 4%, 410 to 420, I would say is somewhere the equilibrium for the short-term, Tom. But I think that the market pricing, the markets are thinking that, the Fed will come out and cut rates by 50 basis points in September. I think that's a bit exaggerated because I don't think the Fed is going to show the remarkable hurry that the markets are seeing in cutting rates. They will cut rates in September. I don't think there is any question about it, especially if the data shows continued softness in the labor market and slowing inflation. The rates needn't be as restrictive. That much is clear. So the Fed will come out and cut rates in September, but I think they will cut rates by 25 basis points rather than 50 basis points and go slow because they want to be sure that inflation continues to be on the ebb. They don't want to overdo it at the very beginning. So I think that there is scope for the market pricing to calibrate towards fewer cuts from here.
OK, Bloomberg MLI's Ven Ram in terms of how this market calibrates. Fanciful, the idea of an emergency rate cut and expecting 25 basis points in September. Not that jumbo 50. Always smart on these markets. Ven, thank you very much indeed from my MLive team. Coming up, our interview with the CEO of South Africa's Nedbank. It's one of the biggest lenders in that nation, looking to push beyond the borders of South Africa as well. The earnings story and the ambitions of the new CEO up next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Let's check back in on these markets where there is a sense of at least modest relief after the global rout yesterday. European futures pointing higher by around 1.3% after losses of more than 2% yesterday across the European benchmark. FTSE 100 futures here in the UK looking to add 103 points. S&P futures stateside looking to add 1.5% after the losses of 3% yesterday. Nasdaq 100 futures, meanwhile, looking to add 344 points. Gains of 2% being flagged by these Nasdaq 100 futures again after the rout yesterday. Nasdaq 100 ending lower by around 4%, the worst start to a month since 2008. We know the mega cap, Magnificent Seven were a key drag as well. Concerns about Nvidia around some of the idiosyncratic story there in terms of some of its chip development, also a bit of a drag. But broadly, you are looking at a brighter setup after the historic routes that we saw yesterday. Across the board, we can look, maybe flip and go cross-asset, look what's happening in the yen and treasuries as well, because we're also seeing a little bit of selling coming through for US treasuries after gains, the bond rally, of course, after the last week or so, that massive bond rally, and a little bit of that story being unwound in the session so far, with yields up 6 basis points at 398. Ven Ram from our Markets Live team saying he does expect a little bit more selling to come through at the front end, given how much money has moved in to the front end of the Treasury market in the last week. The Japanese yen is seeing a little bit of weakness in the session after the significant strength of yesterday, currently at 145 versus the US dollar, down 1%, 1.2%. Brent at $77 a barrel, gaining at 1.2%. We keep an eye, of course, on the risks around a further flare-up of tensions between Iran and Israel. Bitcoin at 55,819, gaining 2.6% after the losses of 10% yesterday. Let's get back to the earnings story and focus on the EM space, with South Africa's Nedbank reporting net interest income for the first half year that missed estimates. This is the banking group announced an interim dividend ahead of forecasts. It's also worth noting that on a headline basis, earnings per share came in higher year on year at 16.5 rands versus 14.77 rand. That is year on year headline earnings for this bank. Let's bring in the CEO of Nedbank right now, recently appointed Jason Quinn. Jason, thanks for joining us. Walk us through what these results tell us about how your bank stands and your outlook for the rest of the year.
Yeah, cheers. Thanks very much, Tom. I think your comments and introduction were fair. Credit extension across the whole of South African market was pretty slow in the first half, and ours was also slow. We were able to take a little bit of share in some key products like mortgages, vehicles, took some deposit share as well, which we were pleased with. So overall, from here on out, in fact, we think rates come down a little bit in the second half. We think that stimulates the economy, stimulates credit appetite a bit. We think that the government of national unity is establishing nicely, which puts a little bit more growth in the picture as well. So we're a bit more optimistic about the second half. And as you say, we were a bit behind on interest income, but on non-interest income, trading and all of the other lines, costs and impairments, we were better. And therefore, the bottom line headline earnings came through a bit better than expected as well.
Jason, on the rates question, your team had flagged 2 cuts in terms of rates by about 25 basis points in September and November, and you just reiterated your view that rates will move lower in South Africa. I just wonder whether that view has adjusted on the back of what we've seen in terms of pricing around the Federal Reserve, with markets now pricing in from the Fed cuts of more than 100 basis points by the end of the year. The read across then to South Africa from this dramatic readjustment that we're seeing when it comes to these global central banks.
Yeah, Tom, we up till now, we've seen rates being cut, as you say, by 50 basis points in the second half, finishing at prime of 11.25, and then another 75 next year, bringing it down to 10.5. I think, there's obviously a lot of uncertainty over the last couple of days around the pace of the Fed and what it may or may not do. I think the South African idiosyncratic factors are less at play now, because our inflation is trending down nicely and growth is starting to resume with lower load shedding and the like. So we're all watching the global developments very carefully. We haven't updated our forecast yet, Tom, over the last couple of days.
You're a very domestically focused bank. I believe around 95% of revenues come from South Africa. What is your plan, Jason, for pushing beyond the boundaries, or beyond the borders of South Africa to the wider region? And what specifically are you looking to implement to drive that external growth?
Yeah, thanks, Tom. That's a great question. Yeah, you're right. Nedbank is very much a South African bank. In fact, actually, we still see opportunities in the South African market. We have some businesses in South Africa which are at scale and leading, and we have others that we can grow into, which is a very good position to be in. So we'd like to capture some more growth in South Africa, to be honest. And then steadily, as opportunities emerge across the continent, we would like to diversify our portfolio more. That'll take some time, though, because entry points are scarce and you have to be quite delicate as you do that. But over time, you'd want to think that we could expand our business outside South Africa further.
You've got Tier 1 capital that's above the target set by your board. Is there more that you can do either on M&A, Jason, or in terms of returning cash to shareholders?
Yeah, Thomas, definitely both of those. As I mentioned just now, as we look to expand our business, we would look at M&A. We did a small deal in the first half. And so that's part of our capital surplus would be deployed for growth. And then we did announce today as well that we have all the necessary approvals in place to execute a share buyback. Depending on market conditions. We did execute a fairly material share buyback not so long ago of about 5 billion rand. So that is on the table as well. So both options are being considered.
OK, so M&A in focus at the bank, and you have that approval in terms of the buybacks. Nedbank CEO Jason Quinn, really appreciate your time. We've run short of time, I'm afraid, but really appreciate your update in terms of the earnings story and the outlook for this key South African bank. Thank you. There's plenty more coming up. This is Bloomberg.
I am of the view that we will look back on this and say it was an overreaction in certain parts of the markets. And the market got carried away by demanding intermeeting cuts, by demanding 75 basis points in September. It's not going to happen. It's not going to happen. The Fed will look at the economy and say, yes, it's weakening, but this is not an emergency situation such as the ones we've seen before.
Okay, Bloomberg opinion columnist Mohammed El-Erian, of course, speaking there, saying the market has overreacted, and have to wonder whether the disinversion of the 2s10s yield curve was part of that overreaction, at least momentarily disinverting. And of course, for many, that will flash a warning sign around those recession risks, given it has been that harbinger of recession. Not always, but quite often. And that did happen and come to the fore yesterday. We'll see to what extent that story remains in focus. Again, markets pricing in around 4 basis points, 4 cuts, I should say. 4 cuts from the Fed by the end of the year, over 100 basis points. So we're watching that, given that came through yesterday, and the signal that will send to some that a recession is in the cards. Let's flip the board and look at the volatility moves, because the VIX, of course, and that massive pop that we saw yesterday, these are levels we haven't seen really since the COVID crisis and the great financial crisis as well. So back to those historic levels in terms of volatility and what that means for some of those systematic trades as well, and unwinding some of those given that jump up in volatility, and whether you got a domino effect on the back of that. So we watch to see that easing, of course, in the session today, but volatility and that spike yesterday being pronounced. Let's flip the board and look at Nvidia, because this has been, talking volatility, a very volatile stock indeed. Sometimes it looks like it's moving more aggressively even than some cryptocurrencies out there. By the way, it's down about 25%, a little over 20%, 25% from its peak back in June. And then there are the idiosyncratic stories around Nvidia in terms of the challenges around engineering some of its new chips that are coming through. They hope to have in the hands of their customers by the end of this year, the Blackwell chips. And of course, the run-up around this stock has been so pronounced. BlackRock, by the way, saying, don't forget, Nvidia does have those structural drivers. They are still not able to meet the demand in terms of getting the supply out. That demand remains tight, and Jensen Huang has been talking about that leading into 2025. The earnings, by the way, from Nvidia, August the 28th, and you can imagine, of course, the scrutiny when we count down to that earnings story out of Nvidia. 8 a.m., by the way, we're going to be speaking to the CEO of IHG Hotels and Resorts. It's another big day, of course, from earnings, so that CEO conversation coming up in the next hour or so. Before that, the opening trade kicking off, setting you up for this trading day across Europe, with European futures pointing to gains, making up for some of the losses of yesterday. Stay with us. This is Bloomberg.